Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host here for about the next, I think, 30 minutes today here on Options Guide TV. Well, a lot of interesting things that are happening. We've seen, the AI news has really blindsided the marketplace. Nobody really knows what to do with it. NVIDIA got killed and then bounced back and now is getting hurt again. In other words, we revived the stock, but now we today, for some reason, we're going right back down to where we started at the beginning of the week. So this week we looked at a front spread in NVIDIA, and that was probably the main trade that we looked at, and saying that, well, if you do think you're going to get the dead cat bounce, for lack of a better term, and you think that NVIDIA can come back to where it was before the AI news hit, which was right around the 242 level, and if that is the case and you think that it can come back, we got a strategy for you. What we're going to do is basically a covered call on steroids. We're going to buy one, sell two, a ratio spread that centers around NVIDIA making a move back up, doing it for a net credit to the account. We also talked about possible protection strategies. We looked at a collar where we're buying a put and then selling a call to pay for it. And NVIDIA was right now it's down $6 at 122.76. When this all started, it was at right around 140. So we came all the way back yesterday, had a real strong move up about 10 in NVIDIA. Now we're giving back about 5% today. So I guess everybody's decided that the news is real out of China with DeepSeek and what the potential is going to happen with AI. But there's I don't know, everybody's speculating on what could happen. So let's just go and look at the trade and see where we're at on that trade. So let me get to the what if calculator, and let's start by looking at NVIDIA and the trade that we had set up. Okay. So let me first of all take this, and we're going to send this to the what if calculator, or I'm sorry, we're going to send this to the trade ticket. So let's remove this stock. We got it here, and we'll send that to the ticket. So here is our trade based off of the options grid inside the Tradier Pro software, NVDA. Okay. We don't have earnings until the out towards the 26th, I think, is when earnings is going to be. So they're highlighting earnings in that February 28th expiration. So that allows us to mess with the stock a little bit. And I kind of like the fact that that earnings is not involved. We'll do something around earnings in NVIDIA for sure when we get closer to that date. But we picked the February 14th expiration. So I'm going to click on that. And the concept here is that if you were selling a call option on NVIDIA and you're worried about the underlying stock coming back and maybe getting pegged on the stock, maybe having to sell the stock, I would be selling something right around the 140 level, which is where the stock was when everything started. And that was trading for right around $1 at that point in time. And I just don't really like that risk reward. I don't like the potential that the stock could come back. I'm only going to get $1 for it if I have 100 shares of stock. Doesn't give me a lot of protection, but I don't want to sell anything down here around the 125 or 126 level where you're getting some real value, right? Today, the stock is down 6. If you had sold the 126 right now, right, you'd be bringing in some real protection. You'd be selling it for $4.45. That's real money. I go on up and sell something up where the stock was at before all the news hit, right around the 140. I think it was actually at 142, if I recall right. I'm not going to go look at the chart, but it was somewhere around that range. And that's what I want to sell it for. I want to get all the way back to that level. So if I'm selling a call on this position, I don't want to peg myself lower at these other strikes. Okay, now, so how would I do this? I'm going to come in and I'm going to actually buy a long call spread which will give me some leverage to the upside. And then I'm also going to sell a call against my 100 shares of stock. So I can buy one and sell two. And if I do that here right now, we did this when the stock was way down on the day of the event, which is Monday. And the stock was down, 14, 15 points. And at that point in time, we could get this trade done for a net credit of 50 cents to the account. And so that was our official paper trade. We're saying if you had 100 shares of stock, we're going to do this front spread. And that's what it would, inside the options playbook, the title of it would be a front spread. But that shows you unlimited risk if you are short an extra call as opposed to just buying the long spread where you buy one and sell one. You're buying one and selling two, bringing in a net credit of 50 cents to the account. If it goes down, you get 50 cents as opposed to selling the 140 where you get a buck. You know, that's not that big of a deal. But here's where it gets interesting. And in order to highlight that, I'm going to go to the what if calculator. You toss the stock in here, and we're saying that from 131 to 137, it's like owning NVIDIA on margin, right? So from this point on to that point, we are long a call spread. And so for every point move, we could potentially make that long call spread could trade for as much as $6. We didn't pay for the long call spread. Why? Because we sold two option contracts. Why could we sell two option contracts? Because we had 100 shares of stock. So it's covered. So from that 137 on up, we still have the risk that the stock could be taken away. But from 131 to 137, we have the potential to sell our long call spread for somewhere close to $6. Now, there's 14 days remaining. We still need the stock to move back up. But if it goes on down, well, we're not any worse off than we were before, unless you were thinking that maybe you were just going to sell NVIDIA outright and say, I don't want the cheese anymore. Just let me out of the trap. But I don't feel like that is the real sentiment and what a lot of people, what a lot of the pundits are saying as far as NVIDIA is concerned. Obviously, anything can happen in this space. But with that mentioned, if you were really nervous on NVIDIA and were worried and wanted to sell, well, an alternative would have been to do a collar, which we talked about on Monday. And that's still an alternative. If this moved to the downside again with NVIDIA going down 6 today, actually almost 7 at this point, it's down 5.5% as I see it scrolling across the screen up here. So with that mentioned, I like this trade if you own 100 shares of stock. And I do own quite a few shares of NVIDIA, and I put this trade on about half of my position. Actually, it was a little more, about 3/4 of the position. I think I left 100 shares out there just hanging around. So I have this position on in my account, the exact same one right here, and I did execute it. I think I got a 60-cent net credit to the account. When we did it on the show, it was trading for a 50-cent net credit. So what we're doing is a basic long call spread, and then we're going to sell an extra call because we're saying we have 100 shares of NVIDIA already in our account. And if we do that, then the profit and loss graph looks like this. From 131 all the way up to 137. It's a 1x2 rise over run. So it's like owning NVIDIA on margin. Now, the long call spread won't max out until you get closer to the expiration date. That's the only thing that is a hindrance to this position, is that you do need the 137 strike call to get some time decay in it in order for the long call spread to pay out, let alone the fact that you have a call option that you just really want to expire. And also, I want to set an alert. If I get to 137, I don't want my stock taken away. I don't have any desire. I want to hold on to NVIDIA for a while. So with this in my own account, if it gets to this level, I would roll the one call that would call away my 100 shares of stock that we're looking at in this example. And that's how I would play this trade going out. who knows what's going to happen next as far as AI is concerned. Apple and Meta have done really well based off of this news, and Apple needed it. They were actually looking at the fundamentals in Apple, and that was driving the stock lower. And then all of a sudden, this news comes out about AI, and the stock is skyrocketing as we head into earnings. Apple is going to be announcing earnings after the close today, and it'll be very interesting to see where it's at. I did not really want to touch it, mainly because it went down on fundamentals and went up on news. And normally Apple will have a tendency to sell off after an earnings event, but who knows at this point in time what exactly will happen with Apple. If anything, I just expect Apple to probably do more than what is expected. So if I was looking at buying the long straddle or selling the long straddle, basically playing the over under on the move in Apple as it heads into earnings, I think I would do the over and buy the long straddle. But I'm not going to do that. I'm just not going to mess with that at all today. Now, if you have any questions about the NVIDIA trade or any of the trades that we looked at on Monday, because we looked at a lot more than just this front spread or basically this covered call on steroids. We looked at just buying protection. We looked at also doing a collar, trying to get cheap protection in NVIDIA, and I'm happy to answer any of those questions that you may have. Now, with that said, I'm going to move on to the next trade. Since we're not going to look at Apple, another stock that's going to be announcing earnings after the close tomorrow on Thursday is Visa. So I'm going to look at a trade in Visa. Visa, well, let's look at the chart here to start with. And if I can get it to come up, let's go look at Visa. Parabolic, right? And I do think that this might be a buy the rumor, sell the news scenario. If we do get a decent earnings report, it's a reason to maybe sell off, considering the strong move to the upside that we've seen in the credit card industry in general. MC is also doing very well too, MasterCard. No, that's not good. Is the symbol for that. So with that said, let's just, I digress. Let's look at, we're going to do a skip strike butterfly in Visa. So if I look at the very short-term trading in Visa, type in that symbol, and we look at the earnings. So the earnings is on Thursday after the close. So the Friday option contract, the January 31st expiration, will live for 1 day. See, the stock is up again today, up 0.5%. That's nothing to sneeze at, right? Up $1.67 heading into that earnings. You have an entire day before the earnings report comes out. So as always, you can adjust the trade. But if I were to set it up today, if I thought that they were going to be announcing earnings, if they were announcing earnings on a day of the show, here's how I would look at it. We're going to go out to, let's get rid of this trade. We're going to go out about a 1 standard deviation move. We're going to look at the 350 strike. The delta on this is 16, so we're right at a 1 standard deviation move. And one of the things that I love about the Tradier Pro option grid is that it kind of highlights that area. It doesn't kind of, it highlights about where a 1 standard deviation move is at relative to the strikes. And there's always a quick and dirty way to look at that and just look at the delta, and that delta should be right around 16. It's right about a 1 standard deviation move. And that means that 16% of the time, this option contract will finish in the money. That's basically what the delta is telling. Okay, so a low probability of it getting there, but there's still a chance. And I don't want the stock to blow us out of the water. So here's what we're going to do. We're going to buy the 350 strike call, and at the same time, we're going to sell 2 of the 352 50s, okay? And we're going to skip the 355s and buy the 357 50s right here. we can get this done. It was a little bit higher. It was about a 20-cent net credit earlier when I was looking at this trade. I guess we can adjust it. And right now it's 20 cents on the bid. And I guess we'd have to move it up maybe a little bit. Let's move it. Let's hit this ask and sell 2 of these. Skip that and buy the 60. We're still at about 6 cents. All right. Well, we'll still make this be the paper trade. So now, if I'm doing this trade, if the market comes up towards the 352.50 level, you have 1 day to expiration. We might be able to put this on for a net credit and take it off for a net credit. I liked it a lot better at 20 cents, but we're going to say it's 6 cents right now. And so if the market goes down, we'll make 6 cents on the trade. If it trades anywhere in this level right here, then we're just basically going to break even on the trade. Our total risk for the trade is going to be $2.50. And that's the difference from the 357.50 strike to the 360 strike. So if we send this to the what if calculator, the way that the trade looks is the stock is right here. To start with, you have the risk if the market goes up. You have the green line showing you the profit and loss graph, on the trade. But now what's going to happen is they're going to announce earnings on Thursday after the close. All the time premium will come out of the option contracts from a decrease in implied volatility. If the stock runs up and makes about a 1 standard deviation move to the upside, then this green line will morph into what happens on the expiration date. And if we can do this and we get this trade done, well, with the potential upside is about $2.50. That's where the maximum upside is at, plus the net credit of 6 cents to the account if we get it done for that 6 cent net credit to the account. So it's a trade that doesn't have a high probability of making a home run on the trade where you make the 250. So if I put the trade on, put it on for 6 cents, we have $2.50 worth of risk total. That's the maximum we could lose. If the underlying stock blew through a 1 standard deviation move, went all the way up to the 360 level in this instance, then we would be at our max loss. And our max loss, you'll see it right over here. You can highlight it over in this corner, is right at the 250 level. Minus the 6 cents brought in. I really wish we could get it done for closer to 20. But in that instance, that's our max risk on the trade. If we get the stock to drift this way, this will start drifting that way. And we have the potential to, if I could sell this for $1, I'm going to put it on for a 6 cent net credit. If the market goes down, oh well, we're going to break even on the trade, basically. If the market does come up and I can get out of this trade for $1, I'm going to do that. I don't have a lot of risk. I'm only risking $2.50. If I can make $1.25, half of that, that would be awesome on the trade. But in order for that to happen, I need a fairly decent move to the upside. And we're going to know in 1 day. In 1 day, this trade will be done, and we'll be able to move on to the next trade. So on Friday, we'll be able to take a peek at this, see where it's at, because we're going to be announcing on Thursday. And that's going to be it. If we have any other questions... No, I do not see any questions. Thank you for stopping in. We'll see you this Friday for the next edition of Options Guide TV. We'll see how the Visa trade did, and then we'll also look at what's going on with NVIDIA and where we're at there. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.